Hi guys, let me get my screen share set up. Thanks for joining me today. We are going to dive in here real quick on how to get started as a passive investor. This is the next episode in our series. We're going to talk about how to vet deals in 10 simple steps today. And if you haven't joined me before on one of these webinars, welcome. Thank you so much for joining. I want to make sure that you have found your chat box. Okay, so you guys make sure, go over there. Somebody will drop a message in the chat box just letting me know that you can hear me and see me. That'd be fantastic. I like to always do these kind of sound checks before we get going. Nothing worse than getting 5 minutes in the webinar and somebody texting you saying they can't hear you. All right, perfect. So again, if you just, I'm admitting people as we get started here. So if you're joining us today, we are jumping in on how to vet a deal in 10 simple steps. So we're also going to take a look at a deal today as well and work through the steps. So we're going to get some hands-on experience. But if you haven't joined me for one of these before, I just want to make sure, are you ready? We are going to learn the 3 things that you can control when investing to protect your money. We're also going to look learn what to look for when reviewing an investment summary, and then we're going to understand learn how to understand if a deal is a good deal in under 10 minutes. So basically, these series are for you. I mean, have you tried investing in syndications before but got cold feet? Maybe invested in syndication before but realized you made a mistake. Or maybe you're just kind of like, oh my gosh, there's so much information out there and you're just in complete overwhelm and you don't know what to do. If any of these apply to you, you're in the right place. But let's go ahead and start off here and demystify one of our biggest lies that investors tell themselves about investing in syndications. And that is they feel that they have no control. And it's this mindset that keeps a lot of people sidelined, okay? If you were with me last week, we went over the 3 things that you can absolutely control in a syndication investment. We'll quickly review those today. We also went through the 4 tenets of conservative investing. This is what I personally believe in as an investor, but also what we believe in here at Goodegg. Before I launch into all the content, if this is your first time here, this is me and my crazy family. I just want you to, I'm the one obviously the one in the Colorado hat, but we're standing on top of the Copa Pyramid here in Mexico, right outside of Tulum. And this was one of our last big adventures before the whole COVID shut down, and I hope to take many more. But real estate has been such an amazing opportunity for my family. We've been able to create passive cash flow, equity growth, and more importantly, those are just tools. They've allowed us to take control of our time, and make work optional for us and just be together more as a family unit so we can have more memories and experiences like this. If you haven't gotten to know me a little bit better, if we haven't jumped on the phone, I'm going to give you my details at the end, and we can make sure that we connect here soon, because I would like to get to know you better. We are basically, like when I got started in real estate, I was doing a ton of live-in flipping, okay, and house hacking. My husband and I scaled up our portfolio, and then we transitioned into more single-family investments, got our portfolio up to 30 units there, and then that's when we wanted to basically, sorry, I got Julie texting me. Hold on, please, guys. There must be something going on here. All right, let me make sure I get her that information. She wants to join us today. So hold on, guys. This will be like a really cool treat for us. All right. Thank you for your patience. Nothing like one of our CEO jumping on the webinar and joining us. So she should be here momentarily. That's amazing. Okay, cool. So Anyways, where was I? So we scaled up our portfolio to about 30 single family properties. And then, it really kind of dawned on us that I had created another job for myself. And so that at the same time, I had actually invested in some syndication deals within my IRA. We can, kind of go through whether that was a good idea or not. But anyways, that's when it really dawned on me that I needed to start scaling up through multifamily. And when I started putting together my own multifamily team, that's when I realized that I couldn't really do it better than these pros were already doing it. And so fast forward here, a couple years later with Goodegg Investments, we've done over 24 deals, have over 6,000 multifamily units and over a $700 million portfolio value. But really, the cool thing is I get to work with you guys every single day. And we have over 600 verified investors like you that I get to work with, and then many, many repeat investors. Over 40% of our investors repeat with us. If this is your first webinar with us, again, welcome. These are just kind of a few things that we've been able to tackle over the past year, again, to add value to you, beef up your education, demystify this entire process for you. We've written a book, Investing for Good. We've launched a podcast, Investing for Good, by the same name with Julie and Annie. We've gotten to meet many of our, connect with many of our operators, but also meet many of our investors at tons of conferences throughout the year. And then of course, working hard for you on your behalf and visiting the various investments that we have. All right, quick recap. Again, this series is for you. And what we tackled last week was how you can have control over an investment when investing in real estate syndications. And so we tackled the 4 tenets of conservative investing. All right, we went over how we here at Goodegg, our number one job is to preserve your capital. Okay, Warren Buffett's rule number 1 of investing: don't lose money. Okay. Rule number 2 technically is seen rule number 1, but our rule number 2 is cash flow. That's the second thing that we do for our investors. So we really take care to stack as many investing cards in your favor, so we are purchasing stabilized assets from day 1, and we can distribute the cash flow. Okay, so those are the first main two: capital preservation, cash flow. And then when you invest in a syndication asset, it's very different than investing in a single family house if that's your background, because we can actually increase the net operating income on the asset, and therefore we get to control the appreciation of the asset. So that's a pretty wild thing that we get to do. Okay, and so we get to control that net operating income by pulling 3 levers. 1, pushing the asset to market rents. 2, reworking the profit and loss statements. And then 3, adding additional streams of income on top. And then our 4th benefit that we have here is tax benefits. Okay, a lot of people get into real estate because they love the tax benefits that real estate can afford them. We can actually accelerate those tax benefits through depreciation and cost segregation. All right, and possibly a 1031 exchange at the end. So that's just a quick recap there of the 4 tenets of conservative investing. But then we also tackled, how do you get to control the asset, right? Number 1, you get to choose the operator you work with, right? This is different than if you've ever invested in a single family house. You probably picked the deal first and invested in a market that you were familiar with. And then you go, oh, okay, great, I'm gonna put this with a property manager. So most people have worked this backwards, all right? They've done the deal, then the market, then the operator. Here, we think entirely opposite. You are investing in an operating business. So it's most important for you to choose the best operator out there. You get to vet the markets. We talked about how you can vet a market last week. And then we also talked about how you get to choose the deal, okay? And when you pull, again, like kind of pull those 3 levers, tap into those 3 secrets, you actually have quite a bit of control over your investment, all right? So it's this secret number 3, choosing the deal, that we are gonna deep dive in on today. All right, so what to look for and how to underwrite the deal. All right, so I'm going to pull up here an investor summary, but let's kind of go over the mechanics of an investor summary and then dive into what I call a 5-minute checklist. All right, so most investment summaries that you look at are going to be broken out into like 5 main components. One, there's going to be an executive summary at the very beginning. All right, that's going to show the overarching returns, the basic plan, the loan, and then also the structure of the deal between the LPs and the GPs. Okay, and if you don't know what LPs and GPs are, general partners are GP are the people that are actually running the operating business of the company, and then the LPs are the limited partners, and generally LPs will contribute the capital and then are more silent after that. All right. The second part of the investment summary is the investment offerings, okay? This just goes into a whole recap. It expands on the executive summary of why this deal is a good deal. Third part you're gonna get is the property overview. So this will go through the grounds, the amenities, the unit mixture, okay? And it's worthwhile for us to look at this, okay? I know many investors get very honed in on what the returns are of the deal, but we actually want to, it's just like picking a single family house or like a property. We want to make sure it's in a good area of town, close to great amenities, and that it has a good unit mixture that can appeal to many different types of tenants, okay? When I mean unit mixture, 1 bedroom, 1 bath, 2 bedroom, 1 bath, 2 bedroom, 2 bath, maybe some 3 bedroom, 1 bath as well, or 3 bedroom, 2 bath. Again, giving a nice wide range of unit mixture to attract several different tenants into the property, but also as their life situation changes, maybe they get married or they have a child, they can actually scale up within the property. All right. Fourth part of the investment summary is the financials analysis, okay? This is where we go through all the debt on the property, the return of investment, the cash flow projections. We're also looking at the rental comps and the sales comps, all right? When we execute on a value add strategy, so we don't necessarily want to be the best kid on the block starting off. We want to be somewhere, in the mid-range. We want to know that we have room to grow and actually still stay under the leading competitor in the market. And then the sensitivity analysis. And sensitivity analysis purely means like how sensitive is the deal to the market pressure, okay? So as what happens if cap rates go up, okay? Does our deal structure still work? What happens if we have more economic vacancy or physical vacancy at the property? Does our deal still work? And you want to make sure that the operator has actually not put their hand over their eyes and wish this deal works, but that the numbers prove that it works. All right. And then the last part is generally a very extensive part going over the market overview. It goes over the MSA, which is the Metropolitan Service Area. Okay, what makes all the different, what makes up the whole entire market as far as population growth, job growth, income growth, job diversity. And then we look at those factors at the sub-market level. We also are going to look at vacancy rates, okay, poverty, eviction rates and stuff like that at the sub-market level. Okay, so these are the different sections of our investment summary. We'll take a look at one here in just a second. But let's go over our checklist. Okay, so here are some questions. All right, high-level questions. But I wanted to offer you guys a tool to make this easier. Okay. And this checklist, this tool that I'm about to show you is really great if you're looking at value add B class properties, okay? That's what that tool is geared towards. If you're looking at stabilized A class properties, your underwriting is gonna be a little bit different, okay? So I just wanna kind of ground it at that. These questions right here on the screen, asset class, how many units, the equity multiple, IRR, type of lending, all of these questions are going to apply to any deal, It's just mainly how do they break down and how do we know what is a good deal? It's this particular checklist that's going to apply to a value add B class deal. Okay. So let's go through this really quick. All right. I'm going to show you guys a deal here in a second. We're going to go through the different parts of the investment summary. We're going to look to see, how this whole investment deal pans out. But if I really wanted to invest in a value add B class property, obviously, if that's my investment strategy, I want my asset class to be a B, okay? Now, why would I put C under ideal, right? If I can buy a C class property in a B area, that might work for me as well, okay? Because I can then raise the class of the property up a level, okay? What will not work for me is if I buy a B class property in a C area, okay? So number one, asset class, what are we buying? What is our strategy? Number of units, okay? We like institutional grade properties. So we're looking for 100 units or more. I really think the market is going to afford us some great opportunity in this 50 to 100 unit range. So be on the lookout for some deals coming out in that area range as well. So that's really super exciting for us right now. Equity multiple, okay? I like deals that are going to double my money in whatever the hold period is, in this case, 5 years. So equity multiple, I would like that closer to 2x, meaning that if I put in $50,000, 5 years later, I have a reasonable expectation or chance of doubling my money to $100,000 between cash flow and equity, okay? So that would be closer to 2x, all right? And as you can see, this kind of slides down, has a sliding scale down to the right, all right? Internal rate of return. What is my return expected to be annually over each year of the hold? Okay, now this is, definitely a different calculation than annualized return. But if I'm looking at a 2x multiple, generally my internal rate of return is going to be 16% or higher. Okay, that's what I'm targeting for an IRR. Type of loan. Okay, let's talk about this for a second. Lending right now is definitely kind of a tricky one because we are seeing agency debt, the Fannie Mae, Freddie Mac loans being the easiest to secure right now. Okay, and I don't want to say easy that everybody can secure one, but those are the debt. That's the debt that's generally available, and that's the type of debt we'd like to see on our properties. Again, agency debt. It is backed by a government agency, by Fannie Mae or Freddie Mac, and it's non-recourse, meaning that the debt is to the asset, not to the individual investors or the GP or a key partner of the asset. Okay, so non-recourse. If the deal were to go south, the bank holds the majority of the responsibility on that debt for that loan. Okay. All right, loan interest. Okay, we want to understand if our business plan is to hold the property for 5 years. Okay. This is a question for you guys. Go to the chat box. If my business plan is to hold the property for 5 years and I see a 3-year fixed rate loan on it, is that good or bad? Go to the chat box. I want you guys to type it in. Okay. Ani says bad. What are you guys, how does everybody else feel about that? I got a bad with a question mark. Okay. I'm gonna say it depends. We need to actually ask further, okay? Could be bad, yay, okay, yes. All right, so we need to ask further, okay? If my loan loan rate's only fixed for 3 years, I want to know from the operator, can that rate be fixed, extended and fixed for longer than my hold project? If it can be fixed and extended to 5 to 7 years, now go to the chat box. Is that good or bad? Good, yay. Okay, now I'm kind of like thinking, yes, that this might be like a better deal, right? So just because you see an initial loan rate and a fixed rate, you always want to ask more questions on how long that rate's fixed and can it be extended. All right, that should be in the investment summary somewhere, but always ask that question. Okay. Now, if I automatically am getting, now why would I get a loan for just 3 years and knowing my hold is projected for 5? Why would I even do that? It's because I might actually get through majority of my business plan in 3 years and the market might be good and I want to sell. And that type of loan will be cheaper to the overall business plan than if I went ahead and fixed it for 5 to 7 years. Okay. So we're seeing a lot of that right now, but most importantly, I'm driving home this point. You want to make sure the loan interest rate can be fixed for the life cycle of the business plan. Okay. In this case, at least 5 years. Okay, if it's less than 5 years, we need to talk about what's going to happen and work through those conversations. All right, reversion cap rate. All right, I'm going to ask a question. This is testing you guys. I know some of you guys have been here multiple times in a row. Does my asset value go up or down when my cap rate rises? Go to the chat box. I want you guys to throw that in there. Ooh, down with a question mark. Okay, up. Ooh, interesting. Okay. All right. My asset value, if cap rates go up, my asset value will pull down. Okay. It doesn't mean that it goes down. It will pull down. It means if I have $100,000, if I create $100,000 in equity and my cap rate is 4%, doing some quick math for you guys here, then I created $2.5 million in equity. Okay. All right, or increasing the value of the asset, $2.5 million. Now, if I take the same net operating income growth and it's $100,000, okay, I'm still adding money to the bottom line, and I divide it by a 5% cap rate. Okay, now I've added $2 million to my asset. Okay, so my asset value can actually go up in both cases, but it's just not going to go up as high if cap rates are rising. Okay, now why is this important? Because we want to understand that the operator has actually underwritten that reversion cap rate or the exit cap rate. And you will see on all our performance that we actually underwrite the property to be at least 0.5% worse, the cap rate to be 0.5% worse, meaning it is risen, when we exit the property. So essentially we're saying under market conditions, we are underwriting this property and we're saying that, that the market will be worse upon exit, okay, from what we bought it at today. And that's very conservative underwriting. So you just want to make sure that you see that in a pro forma. All right, market rents, sales comps. All right, we want to make sure, again, I already talked about it, we want to make sure that we are not the best kid on the block. We want to make sure there's room for us to grow. If you see a pro forma and the rental comp for that purchase, especially on a value add property, is already at the top leader of the market, we don't have anywhere to go if we add, do a cosmetic rehab and try to push rents. Okay, so you want to make sure that there are some market leaders above you that we can kind of catch, and that's called a rent premium. We want to capture those rent premiums. All right, and then also when we're looking at the pro forma, we want to make sure that we're that the operator is actually underwriting a pretty conservative rent growth. Okay, and that means, okay, every year we can maybe tick up as leases renew, we can tick up rents. All right, I see this quite often, especially in the single family world, where a turnkey provider will put out a pro forma and they'll say rent growth 5% year over year. Maybe. It's all market dependent. Okay, so we want to make sure that we're being very conservative on those numbers. Okay, under promise, over deliver. If we can underwrite that business plan and it works at 2% rent growth, 3% rent growth, you're going to be extremely happy with me when I can deliver 5. Okay, it's not unheard of. But again, we want to be conservative. And then again, projected vacancy. Okay, we want to be pretty conservative on vacancy, especially right now in this market. You have physical vacancy and you have economic vacancy. All right, so I would say, again, being very conservative, at least 10% a year. We want to make sure that the operators are not being overzealous about what can happen actually at the property level. Okay, you guys ready to dive into an investment summary? While I pull this up, I'm going to push pause. Okay, I'm going to pull up an investment summary. If you guys have questions, go over to the chat box. I want you guys typing those in right now, and we can pepper in some of those questions as we go through. All right. Okay, here we have Hawthorne Willowbrook's Apartments. This is an investment that we closed on last year, a little over a year ago. It is closed in our portfolio. Okay, last time we did this session, we underwrote Carrington. Okay, again, that's closed in our portfolio, but hey, this is another one we can take a look at. All right, so our first section, remember we got 5 sections to our investment summary. Okay, our first one is going to be the executive summary. All right, this is a summary you got to read past here. Okay, but this gives us a lot of like kind of high level overview of what the property is. It tells us the year, the vintage. It's a 2000 year vintage property. It's in a higher B class area. It gives just a 1 sentence overview of the business plan of how we're going to push value on the property, and then we've got permanent fixed rate debt financing for the asset. Okay, but we need to go in further. Okay, we got a couple questions coming in. I'm going to start peppering in answers to these questions as we go through, so you guys hang with me here. All right. On this particular one, we've got a entrance cap rate of 5.08%. Remember, we wanted to see our reversion cap rate at, does anybody remember what we wanted to see it at? I won't make you guys struggle too much. We wanted to at least underwrite it at 0.5%, 50 basis points. Oh, 0.5%, not 0.05, but 0.5%, but very close. Awesome. Okay, so yeah, we just want to, the general rule of thumb is 10 basis points for every year of hold. So if the hold is 7 years, we'd like to see an underwriting at 0.7. Okay. All right. We've got our debt service coverage ratio. Okay. Again, definitely higher than 1.25. That's amazing. We can go into the calculation that number later. Our purchase price, our hold time, what the equity is required, how much, this is generally the raise, how much equity is required to close on the deal. Our equity multiple, we wanted to see our equity multiple close to where? About 2x, okay? And that's for my underwriting, okay? You might be happy with the deal at 1.5. That's totally fine. But again, I want my money working hard for me. And if I can get close to 2x and everything else holds the same and is very conservative, I'm going to go for it. Okay, now these are average annual rates of return. Okay, 8.7 for the cash and cash for the year, and then 18.3 average annual return. In my internal rate of return, again, we wanted to get it close to that 16%, and it's at 15.6. Now remember, I'm flipping back here to the chart. Just because I can't check all the boxes in the first column doesn't make it a bad deal. I just need, if I'm comparing multiple deals at a time, now I have kind of a metric to use to decide what would be a good deal for me. Also, I now know what I need to inquire further on. We've got some thresholds here that we've created for ourselves. Okay, so that's the whole point of that checklist. All right, This gives us a little bit more, view into the overall, metrics on the property. Again, we're going to look for a 3.2 rent growth. Okay, that's what it's been experiencing in the past. Okay, probably reasonable expectations going forward. Our value add opportunity, we're looking to do an interior renovation of only 35 renovated units. Okay, I don't have to go super crazy on this and redo all of the units. We can underwrite and get a good value push on just doing 35 of the units. Okay, these are what I'm looking to do: update the countertops, upgrade appliances, add washer and dryers to unit in 100% of their units. Okay, we got a fixed rate agency debt. Okay, 5 years interest only, thumbs up. Okay, and we can dive into that further. Again, competitive property, it's already commanding rents higher than existing rents at the same unit with lower luxury upgrades. So we know we even within our own building, we have upward pressure on rents. So that's amazing. Okay, but we'll take a look at what that looks like across the market. So question came in, would you turn down a deal as an LP if the equity multiple was 1.5x? Not necessarily, no. I would want to look at all the different metrics of the deal. Okay, let me flip back, get my Zoom bar. Hold on, we're right in the middle of the controls. I would just go over here on my spreadsheet and I check box here and inquire further, right? If everything else held true and it was at 1.5x, I would want to ask questions why my equity multiple was pulling down to 1.5. Okay, doesn't break the deal. I just want to ask further and make sure that it actually fits for me. Okay. All right. Now on this particular deal, we have the partnership structure here. Okay, an 8% preferred return, 70-30 split thereafter. Okay, and then we have our waterfall, return in the middle, and we can dive in deeper in that towards the end here. Now, preferred return, I want to demystify that for you guys here. As you look down here on investor returns based on a $100,000 investment, year one, 8%. Okay, so essentially the operators are saying they're going to distribute all of the return, annual percent return to the investor. Okay, 8.3, everything higher going up here. That's great, we're seeing growth. Now, what will probably happen is that we're not going to change the preferred return from 8.3% or 8% to 8.3. What we'll do is we'll continue to distribute the preferred return of the first 8% of the cash flow. And then we're going to hold the rest of it to the end of the year, analyze where we are in relation to the pro forma. And if we are meeting or beating the pro forma, we will distribute the extra cash flow in a lump sum at the end of the year. Okay. So fast forward here to year 4. Reasonable chance that if we're meeting and beating the pro forma at the end of the year, you would get that extra equity bump, or excuse me, cash flow bump to 9% at that point in time. Okay, so that just is kind of how it operates. I don't want you to confuse the preferred return with the annual percent cash flow, because maybe the preferred return is actually 7%, and we're saying, oh great, the cash flow on the property is going to be between 8 and 9%. But there's only preferred return of 7%. Therefore, it's not a good deal. Okay, not the case. Okay, it just is how the operator is choosing to distribute the cash flow in relation to the business plan. Okay. All right, question came in. The 70-30 split is between who? Great question. Okay, so I'm going to do another session here on in a week or so on the capital stack. Okay, meaning all the money that goes into the deal, how does it all break out? Okay, but I'm going to do a quick recap right now for you guys. The top of the capital stack is the senior debt. That's the bank. Okay, and then we might have a supplemental loan or a mezzanine loan. That's the second. Okay, they're debt. All right, and then we've got our equity pieces. Okay, we've got the preferred equity. Okay, remember we just talked about here, our limited partner is getting 8% preferred return. That part of their return falls into the preferred equity. So they get paid out next after when we sell the unit, the senior debt gets paid off, the second debt gets paid off, then the preferred equity partner gets paid off. And then 70-30 split, that's called the common equity. So what we're gonna see, say we push the value on this property and we create a capital gains at the end of $10 million, okay? Not unheard of. $7 million is gonna go to the limited partners, okay? 70%, 70 million, or excuse me, 7 million of that $10 million will go to the limited partners for them to split based on their pro rata share of investment. And then the other 30% goes to the general partner or partners for them to split based on their pro rata share of the investment, okay? So, you know, this is just an added payday for you as a limited partner investor, okay? So in this case, 70% of the capital gains will go to the limited partners, 30% goes to the general partners. Great question. Okay, moving along in our investment summary. Okay, we've got our investment highlights here. Okay, this is just gonna go over the very specifics of the building, unit count, year built, okay, the average square foot per unit, where we are at in occupancy. This is an amazing question for you guys to ask. What is the break-even occupancy on the unit? Okay, I don't get the question enough. I really wish investors like you would ask me this question more. What is the break-even occupancy on the unit? All right, so our last deal that we closed in May, we purchased the property at 96.2% occupied. The break-even occupancy, meaning what if occupancy could fall to 55% and we could still pay all the bills. Okay, that's huge. That's a 40% spread. That's huge. Most of the time we underwrite our properties, we're looking to see a minimum of like 65% spread. Okay, or not spread, sorry. Break-even occupancy is the minimum of 65%, or it can go down to 65%. If it can go lower than that, amazing. Okay, that just makes the deal better. But again, it's kind of like you want to make sure that you can cover all the bills on the property, and we don't have to go back to the investor and go, hey, by the way, we need more money, right? That nobody wants a capital call. Nobody. We don't want to do it. You don't want it. Okay. And I'm in a lot of these deals as well. I don't want to do it. Okay. So again, break-even occupancy. What is that break-even occupancy? All right. Investment highlights. Again, we're kind of moving through here. Okay, this is going to go through, this is going to tell me why this is such a good deal. What are we using the capital for? What's happening in the location right around the building? What makes this such an amazing area? Okay, and for this particular deal, this is in Greenville, South Carolina. It's located right close to the industry triangle. There's a lot of industry moving into the area and a lot of growth happening. Okay, and a lot of infusion actually from government agencies. Okay, as you can see here, it has the country's 8th largest employers that have added 10,000 jobs. Okay, all located within 5 minutes of that area. So it's amazing. Okay, and this will give, you know, again, the investment summary will give you highlights, and then it's going to dive into, you know, specific metrics. Okay, this is one of my favorite ones to look at. It's like, okay, great. We're raising the capital expenditure, the capital budget, all what's needed for us to do the rehab at the beginning of the project. What is it going to go for? Okay, how are we creating value? I, as the investor, want to know that. Okay, this is what we call the value add strategy. Okay, it's rehab. This is how we're rehabbing the building. All right. So we are going to upgrade all these appliances, add brushed nickel hardware, add new lighting, new countertops, luxury vinyl plank flooring, renovate the cabinets. Essentially, we're taking it from the picture on the left and making it look like the picture on the right. And what we're looking to capture is that rent premium, okay? So that is how we're adding money to the bottom line. Okay, let's do some math. You guys ready to do some math with me? All right. So we have 144 units in this building, okay? Let's say we capture a rent premium of $100 on just half the units, okay? So I'm gonna do 77. Hold on, 144 divided by 2, 72. Sorry guys. All right, $100 on 72 units, okay? That's adding another $7,200 a month in just income times 12 months. That's $86,400 a year, okay? Remember, my cap rate was 5.08, so I'm going to divide it by my cap rate, 0.0508. If I can just on half the units add $100 more, I have created $1.7 million in value on that asset. That's awesome. Okay, that's how we create value. It doesn't take a whole lot. All right, small little efficiencies added up over time across multiple units is amazing. Okay, let's see here. Other ways we're adding additional streams of income. Remember I told you those 3 levers. We can increase the rents, we can rework the profit and loss statement, and then we can add additional streams of income. We also have additional value being created here. We get to charge a $40 a month fee for washer and dryer appliances. We get to add $2 per unit for pest control fees, they're not charging for valet trash, so we can actually get to charge that. So we can add that to the bottom line as well. Again, pushing that net operating income. All right, just cruising through the investment summary here. We got demographics, okay. Now this is getting more into like, why this building? Why is this building so cool to look at, right? We've got only 134 units in a proposed 3-mile radius. Housing supply is low in this area, okay? So we are snagging a building in an area where we're adding more jobs, more people, and the housing supply is not increasing. So the supply and demand is gonna work in our favor, all right? Again, we wanted to take a look at the submarket, okay? What's happening in this area of Maudlin, okay? Are there amenities around? Okay, can somebody create a life here? Is there investment in infrastructure around here? Okay, you look at the map, here's our building. It's very well located to highways. There's, central business district is not that far away. There's tons of stuff happening in this area, and that's what we want to see. Okay, here's just another view of it. Okay. They're shopping, okay? People do shop, okay? Even in this age of COVID, we are definitely seeing retail to kind of come back online in some areas, okay? So this is very well situated to 2 major highways and a couple of different shopping areas. So we just want to make sure our residents can actually build a life there. That's so important. Okay, and that there's jobs. What kind of jobs, right? We don't want to just say, okay, great, somebody here can go get a job. We want to see job growth. We want to see diversity of jobs. We don't want an industry to hold a huge slice of the pie. Right now, if I were investing in an area and it was say, 20% or 30% gambling, hotel, convention, yeah, I don't know. I would be a little leery of that right now. I don't know when those industries are going to come back, okay? But if I have good job diversity over multiple business sectors, I am very comfortable with that. Here's another look at the employers. Okay, again, we're not diving in so much on, is this deal a good deal, but I'm showing you where how I would read this and where all the information is found in the investment summary, okay? Property overview. Remember, we got the property overview. A lot of this information is repeated. We're gonna see this, repeated multiple times. But in this property overview section, we're going to dive deeper into the different mechanicals of the building. Okay. Again, we focus on value add. So we're not going to be doing, moving walls and replacing foundations and doing any of these big kind of development type of asset or value adds to the building. We're sticking very cosmetic, and so you can see this in the investment summary. Okay, we're also, you get to peek at the HVAC. How is the plumbing? These are also some findings that will actually be pulled out of the inspection reports. What are the community amenities on the property? Okay, what are we revamping? What are we adding? Those are great questions to ask. I always like looking at this going, if I lived here, could I build a life? Okay, what do I like to do? I got a dog, I like to exercise. I want it close to, my grocery stores. I want to think like my tenant. Could I build a life here? And I really feel like I could. Okay, different unit features. I'm scrolling through here because I want to make sure that we tackle the floor plans and the unit mixture. Okay, so over the next couple of pages, we'll look at the site map and the unit mixture. But again, remember at that beginning, I wanted to make sure that my property could offer multiple experiences to multiple people. So I might have somebody, a single person moving in that just needs a 1-bedroom, 1-bath. And then maybe they get a girlfriend and they want to live together, and now they're in a 2-bedroom, 2-bath. And then maybe they add, they get married, and then they add a child to the mix a couple years later, and they can continue to upgrade within my property. And that's something that I would like to see. All right. Fine. Oh, quick question. Does it matter who does the renovations? What company? Will this information be discussed in the deal? Definitely when we're looking at the renovations, generally the property management or the asset manager will actually be overseeing the renovations, and that will be the specific company may not be disclosed in the deal. You can certainly ask if it's known at that point in time. Most, we generally do know at the time who is going to be doing the renovations, but we just want to make sure it is a reputable person in the area. And preferably, we're going to go back to somebody that we've already done business with. So in this particular case, Hawthorne was actually, it was purchased from a developer. The developer is Hawthorne. So a lot of this it doesn't have like a large amount of deferred maintenance. So we're primarily looking for contractors that are going to do more of the cosmetic type of rehab. Okay. So yes, will it be in the investment summary point blank? Not always, but definitely you can always ask. All right. Will this PDF be available? Guess what? If you are on our Goodegg investor portal, if you have signed up for that portal, it is in there. Okay. You guys can definitely download it from the Goodegg investor portal. If you do not have access to the investor portal, or if you're going, huh, what is that? Email me. I'll give you my email at the end of this presentation. Email me and we will get you set up with an account. The investor portal has a ton of great information on just like what we're going over today, like how do you kind of vet a deal, like how do you get comfortable with syndications in general. And then it also has additional investment summaries for you to take a look at and kind of practice, right? That's what this is here for you. You guys need to practice. All right. Now, you and I have not talked on the phone yet. The first step would be we have to talk on the phone. Okay. So, email me and then we'll take it from there on what the next step is. All right, so let's turn back to our investment strategy. And we're gonna, investment summary. And we're gonna look at the debt financing of this property. So again, we're raising about $7 million. Okay, that is the spread between for the down payment and to raise the money for the capital expenditures. Okay, so we have a loan balance of about $11,350,000. Okay, and our interest rate on this particular loan was 4.8. Okay, that is a quote that gets locked in right before close. Okay, so we generally will kind of know what the range is, and then we'll lock the rate about a week or two before close. All right, so we have 5 years of interest only payments. All right. at a 4.8%. So that's awesome. Okay, our pro forma is 5 years. Our locked interest rate is at 5 years. A good question to ask would be, could we purchase extensions if we needed? Okay, that would be a good question to ask in this scenario. Okay, it looks like we can because our term can go up to 10 years. That's awesome. It's a fixed rate interest loan, amortized over 30 years, prepayment, penalty. And this particular deal is TBD. Okay, again, like you would want to understand if you could actually sell the property at an earlier date if you needed to. Okay, and then a loan assumption fee of 1%. Okay, again, another view of the financials. Okay, debt and cash flow. Okay, so this again gives another look at your, your cash flow and your returns. Okay, I'm trying to get to rental accounts. All right, you usually look for interest-only loans for these deals. So yes, actually. Okay, so in this will answer somebody else's question from earlier. Our strategy is to sell the building. It's not to refinance our investors out and hold the building. So our exit strategy is to sell. All right. If my intent is to sell within 5 years, I can actually create greater cash flow and returns to my investor if I don't have the tenant paying down the principal on the loan. Okay, that's just money that's getting locked up. Okay, I'd rather distribute it in cash flow than lock it up into the asset because of my exit strategy. Now, that said, if my exit strategy was different, if I wanted to hold on to the property, then yeah, maybe I would go for a loan where I was having the tenants pay down the debt and actually, putting money towards that principal balance. But it's because of my exit strategy that I would be seeking out an interest-only loan in this case. All right. All right, as you can see here, of our 1-bedroom, 2-bedroom, and 3-bedroom units, Hawthorne, we are not the leader in the market. We're certainly not the bottom either, right? We've got a couple comps underneath us, but we are not the leader in the market. We have room to grow, and that's what we want to see. We also want to make sure that, our comparable sales, that we are, up there as well, okay? Sensitivity analysis. All right. So this is again, remember I said break-even occupancy. I threw some terms out at you guys earlier. In this sensitivity analysis for this particular property, we actually can break even at 66.5% occupancy. Again, we're close to that 65% that we like to see on our deals. Okay, meaning my occupancy could fall all the way down to 66.5%. And the income that I bring in on the property will cover all the expenses, including the debt service. So that's amazing. All right, cap rate. Our entrance cap rate was close to 5%. We want to make sure that we're underwriting for it to go higher, right? Even if my cap rate went all the way up to 6.5%, my IRR would still be 11.1%. I'm still making better money than the stock market, and it's backed by a hard asset, okay? That is something that I love. I'm getting paid in cash flow as well. Okay, I'm getting cash flow and I'm getting equity. All right, then the 5th section of our investment summary was the market overview, okay? Why Greenville, all right? Why this MSA in general? Why Maudlin as the submarket? And that last section will go over all the different particulars of the MSA in general, looking at job growth, income growth, affordability, the different job diversity in the area. And I would always double check everybody's, double check. This is for you to double check. This is your underwriting. You want to double check all the assumptions in here, okay? A little bit of Googling can go a long ways, all right? All right. Oh, it's Boston Red Sox minor league affiliate. That's amazing. Okay. So we've gone over the 5 different sections of an investment summary. We've gone through our checklist of kind of applied the different pieces of our checklist. I pointed out where to pull them out of the investment summary. The executive summary and the financial analysis summary are going to hold those two areas are going to hold the keys to most of these boxes. Don't stop there. Make sure you read the whole summary. All right. Once you go through and you review your investment summary, make sure you hop on that general partner investor call, ask questions. Okay. Anything that's dropped in your inquire further column, make sure you ask on those calls, or email us and we'll get the answers for them. Okay. And make sure to confirm all the details by taking the time to research the team and the market. All right. We're at the time, of our presentation today where it's great for you. If you have any outstanding questions, jump over in that chat box and we can just start typing them. I'm going to go over a few other key points here. But did you guys learn at least one thing today, or were you reminded of something? Was this useful information? If it was, jump in the chat box, let me know, because these presentations are for you, they're not for me, okay? I want to make sure you guys understand the different parts of, syndication and investing and where to find the information. And if you and I have not talked already, I want you to go to goodegginvestments.com, hit the apply now button, okay, getting started button. I want you to apply to the investor club, okay? That's the only way that I can share deals with you, okay? For those of you who have not already done so, I can also get at you in that Goodegg investor portal. You can get additional information on syndications as well in there, and take a look at a few other deals as well, okay, investment summaries. And just to kind of demystify this, the Goodegg Investor Club is for anybody, whether you're starting out, you're investing pro, whether you do this on the side, you do it full time. If you've invested in a deal, you haven't invested in a deal yet, or you've invested in several, okay, this club is for you. So make sure you reach out to me. I'm going to pop up my information here. Let's get you in the club, get you applied, and then we can hop on the phone, have a quick call. I get to know you better, your investing goals, and we can kind of take it from there. I just want to thank you guys, for everybody, for joining. I know if you got a question in the chat box, I'm going to stay on. I'm going to get all the questions answered from there. But I know some people, we went a little long and some people need to leave, but I want to make sure that you got my information here at the bottom of the screen. Okay. And also, before you leave, let me know what topics you would like to see covered in future sessions. Again, these sessions are for you, okay? I want to make sure that we are answering all your questions. All right, with that, I am going to turn back to the chat box and start taking care of some of these questions. All right. What does it mean to leave meat on the bone when it comes to renovations? Okay. When we are looking at a deal, remember in this particular deal in Hawthorne, we didn't actually have to rehab all of the units to achieve our business plan, okay? And so in theory, we would be leaving meat on the bone for the next person that purchased it for us, okay? So we could achieve our, our 8%, cash flow, our 70-30 split on the back end, our 16% IRR, and not have to do full rehab on the property. Think about it this way. I'm going back up to the executive summary, guys. Think about it this way. It probably takes 2-3 months, for the whole rehab process on a single family house. We're talking about a 144 unit property. We're not getting that done in 3 months. Okay, it takes us 2 to 2.5, 3 years to get that done. Okay, we keep everything stabilized. So as leases turn, we're moving tenants around, we're upgrading them into newer units. They love it, they want to stay there. Okay, our property management is A-class. And then we're going back behind them and we're rehabbing the units. At some point in time, we've achieved our return, we've achieved our net operating income goal, and we can then sell the asset and move on and go do bigger and better things. So that would also be leaving meat on the bone for people. Does it vary between Class A and Class D? I'm not entirely sure the question, but I can give you my opinion of Class A, Class D. So let's take a look at this current market, okay? We like Class B because there's a lot of compression there, okay? Class B, it's workforce housing. The units are affordable, the rents are affordable, it's in good areas of town, next to great amenities, next to good jobs and good school districts. And when the market's on the upswing, we see a C class float up to B, okay? Again, they want better jobs, better schools for their kids, they want better amenities, okay? So in an upswing market, we see compression upwards. In a down market, kind of like what we're, quasi in or heading in, or, I'm not an economist, but like things are not like, what they were 4 months ago. We can all agree on that. A will float down to B, okay? Why? Because they're downsizing, okay? Now here's the cool thing. The way we rehab our units, we're giving it an A-class feel, so they feel extremely comfortable at our units, all right? They're, again, in close to their jobs, in great areas, in great schools, great amenities, okay? So it's not a step down in lifestyle at all, okay? So that's why we choose that B class, okay? Because we get compression. We proved this out in 2008, okay? That, that was a real estate driven market crash, and B class, okay, it wasn't 100% unscathed, but it actually was the class that fared the best in that particular recession. What determines what the class of the property is? Oh, okay, great. So when we're talking multifamily, typically it's going to be the vintage, the year, okay, of the property. So about 2000, or newer is considered a B-class property, okay, in the multifamily space. Now, that depending on the market, that might definition might loosen up just a little bit, but generally we use 2000 or newer. Something that's 10 years old would be considered, a B class. So 2000 to 2010. All right. Yeah, great. I'm glad you guys enjoyed today. A couple of you guys have, sent me private messages asking if you're a part of the club. Make sure to email me directly. We can get that question answered for sure. And anyways, if you guys have any more questions, I'll be happy to stay on the line. Also, if you have any, there's a burning question, there's a topic you guys want me to cover, make sure to drop that in the chat box too, and I would love to tackle that for you on a future episode. Otherwise, thank you guys so much for joining today.